A very good evening, friends. I'm Sanjeev Singhal, Chairman, Auditing and Assurance Standard Board and Central Council Member, Institute of Chartered Accountant of India. Besides, I have the responsibility of being the Chairman of the Public Relation Committee and Vice Chairmanship of Sustainability Reporting Standard Board. On behalf of AASB and on my own behalf, I welcome you all to the 157th program of AASB for this council year. And so far, more than 125,000 members have attended these programs. My appreciation and gratitude to all those. And more than 200 speakers have spoken in these programs. Friends, today's topic is again a very specialized topic, which is audit of the FMCG sector. As we know, FMCG stands for fast-moving consumer goods, and this type of audit has its certain peculiarities in terms of whether it is stock take or at what point of time the revenue is to be treated as revenue, whether the stock with the CFAs belongs to the company or it belongs to the CFO, whether the ownership has passed or not. And obviously with the Ind AS coming in, these complexities have increased. Having this in mind, we have organized this webinar, especially for the FMCG sector. And we have our star speaker, CA Amit Mitra. Amit Bhai is basically a special invitee of Auditing and Assurance Standard Board for many years now and has contributed extensively for the profession. Amit has spoken in hundreds of seminars and webinars for the issue, is a brilliant auditor and a very thorough gentleman. Thank you, Amit Bhai, for taking time for us.
Thank you, sir. Thank you so much, sir.
And we have two moderators, two very young chartered accountants with us, CA Komal Dahiya and CA Tanya Agarwal. It is our endeavor to groom the new speakers. So with that objective in mind, we have requested Komal and Tanya to moderate these sessions. I'll be requesting Komal first, then to speak. And then, we'll be handing over the proceedings to Komal. Friends, we would also like to share with the participants that AASB has come out with two very important publications. One is on the auditing standard checklist and second is on the audit documentation, the sample documentation. And these are available in Word file as well. Please make best use of these as you may feel appropriate. And we also run expert helpline for the full audit season. And for the upcoming audit season also, we'll be doing the same. My gratitude once again to the speaker and moderator for the day and my appreciation for all the participants who are keenly participating in these programs. Thank you, and over to you, Komal.
Good evening, everybody. I thank Sanjeev sir and Vishal sir for giving me this opportunity to moderate the insightful session. And I welcome all the participants who are attending this session. And as Sanjeev sir has told, AASB has conducted various sessions and programs across all the sectors in the past. And this is its 157th CPE program, which is covering the crucial FMCG sector. We all are aware that it's an important sector which accounts for almost the fourth largest sector in an economy. So I would just want to add that apart from the key challenges and considerations like sir has mentioned about revenue recognition, inventory management, as auditors, we should stay updated on the changes in the accounting standards, regulations, and industry practices that may have a huge impact on this sector. And I would also encourage regular communication with the management and a thorough understanding of the company's operations, which is very essential for a comprehensive and effective audit. I would now like to invite my co-moderator, Tanya Agarwal, to introduce our speaker.
Yeah. Thanks, Komal, for such a warm welcome. I would also like to thank Sanjeev sir and Vishal sir for supporting, for making this event possible, and would like to thank all the participants for joining today's session. So, as co-moderators, Komal and I are here to ensure that this webinar runs smoothly and you have a valuable and enriching experience. Hence, your participation is not just welcomed, but encouraged. So please feel free to submit your questions in the chat, and we will do our best to address as many as possible at the end of the sessions. Now I would like to introduce our today's guest speaker, Mr. Amit sir. Mr. Amit Mitra. Basically, Amit is a senior partner with MKSN Associates and has over 24 years of rich experience in audit and accounting services to domestic and international clients. An ardent speaker in various forms, he possesses rich exposure of IFRS, a lead partner on several listed and large multinational engagements. Besides this, he has excellent exposure in the implementation of internal financial control framework. Further, he is a joint leader of professional practice group of the firm and is head of audit and accounting quality management for the India firm. He is a special invitee to the Audit Assurance Standard Board since 2019, part of subcommittee working on SQM1 and SQM2. He's also a peer reviewer and is a technical reviewer contributing to the FFRB of the ICAI. We welcome you, sir, on this platform and request you to enlighten us on the today's topic. Over to you, sir. Thank you.
Thank you. First of all, my heartfelt thanks to Sanjeev ji and Vishal ji for giving me this opportunity, for allowing me to share my thought process on this ever complicated topic on FMCG. Thank you, Tanya ji. Thank you, Komal ji, for introducing me. I will try and do my best to justify this opportunity given to me. Am I properly audible?
Yes, Amit. Yes. Yes.
Okay. I'll share my screen. Is the screen visible?
Yes.
Okay. Okay. So good afternoon, friends, and good afternoon to all on the dais. Thank you for attending this session on a Monday afternoon, which generally is extremely busy for all of us. So as a background, FMCG. But before we touch upon before we dwell upon the complexities on the audit of FMCG, it is extremely important for us to understand the Indian economic scenario. So India is the 5th largest economy in the world in terms of GDP. It also stands as the second runner-up in terms of purchasing power parity, and becoming a 5 trillion GDP will translate into 16 trillion in terms of purchasing power parity. Now, this explosive growth in middle and high income household will boost the consumer sentiment, spending more than 6 trillion by end of this decade on the FMCG. Now, this growth is not only limited to tier 1 cities, it is expanding to tier 2 and tier 3 cities, which have already overtaken in terms of the metropolitan areas, ahead of the metropolitan areas, and in terms of their overall consumption. Currently, FMCG sector constitutes of almost about 35% of the total rural spending on the FMCG, which means 65% is pertaining to the urban area. And considering the India's GDP growth, which is of roughly around 7%, which is one of the highest amongst the world, the parity in terms of spending on the FMCG is only going to increase from here. Now, this sustained growth has resulted in an expansion of all economic sectors, more so which is more dependent on, let's say, the masses. And as no surprise, FMCG is currently the 4th largest sector, and with a workforce of around 3 million people. 3 million people get employment out of this. And of course, the next wave of growth will come from the rural sector. Now, this is extremely important to understand because the FMCG sector per se is directly linked with how the economy progress. Now, if FY 2022, we would have seen that the government of India also introduced productivity-linked incentive PLI schemes specifically for the food processing industry, which forms part of the FMCG, and also to promote the manufacturing in the Make in India initiative. However, the success of PLI will depend on whether the business regulatory framework in the country is conducive or it is deterring. Now, compliance with the laws and regulations, compliance from the management's perspective has become the center stage of the boardroom discussion. And one of the components of compliance is monitoring, which is by the audit. It could be statutory audit or it could be internal audit. So this is how the entire piece would get knitted in terms of how we look at the FMCG. Now, while increasing awareness or improved accessibility and transformation of lifestyles have a key bearing on the FMCG sector, but it is also highly regulated. So, let's say as an introduction, I thought that it is, but only important to have a brief overview of first what FMCG industry is and how is it linked with the Indian economy. A little bit I touched upon in my introductory slide. And what are the India advantages? How is India currently positioned in a more advantageous position from FMCG sector perspective? And then, of course, we touch upon the audit of FMCG company. We'll also dwell upon certain areas within the FMCG sector which are more prone to, let's say a fraud, and where the auditors would need to focus more in terms of the FMCG. Now, FMCG industry in India, like many other countries, is highly sensitive to overall economic environment. Therefore, a detailed look is needed. Now, say for example, a consumer spending power. Now, FMCG sector is closely linked to the disposable income of the consumer. Now, in periods of economic growth, consumer spending typically would increase, leading to higher demand in the FMCG product. And conversely, during the economic downturn, the consumers may cut back on spendings, particularly on the non-essential goods, which also do form part of FMCG and which may have an adverse impact on the industry. And can we say that the inflation has an impact on it as well? Of course, yes. So high inflation will lead to the increase in the cost of raw materials. The oil will go up. If the oil prices go up, the raw material prices go up, the manufacturing goes up, the logistics goes up. And can we squeeze the margin? And of course, then it will end up in squeezing up the FMCG company margin, which in turn would mean that it will have an impact on the pricing of the products. And finally, it will drive down the cheaper versions, and it will reduce the consumption, of course, from a non-essential product. Now, that is the reason why you would see that because India is a very, very price-sensitive market, from the FMCG perspective, you would have seen the packages getting smaller in size. You have 2 rupees package, you have a 3 rupees, you have the size of the Colgate. It was maybe 100 gram 20 years ago. Now you would get a 5 gram or 3 gram Colgate package. That is the reason, because the idea is to beat the prices and ensure that people in masses, because they are price sensitive, get the product. Now, what we have seen over the years is that, of course, in the urban area, because the people have already reached a certain level, the people are generally a high level of income or their mid level of income, which means the FMCG products, the sale of FMCG products has reasonably reached to a nice level, to a good level, and now the growth is expected to come from the rural areas now, because it seems that the 10, 7 or 8 or 10 metros that we have in India, those are reasonably exhausted, of course, with the penetration of digital, penetration of e-commerce. If you read the commentaries of those FMCG companies, or if you see the presentations of those FMCG companies, or any research report, IEBF and all, rural area is the place where the growth is going to come from, because that is a kind of untapped market. The income levels are rising there. The digital penetration is reaching there. The internet penetration is reaching there. Everyone is holding a mobile. There are direct to customer companies which are now catering to the tier 2, tier 3, tier 4, or the other rural villages as well. Now, of course, there are what we will see in our subsequent slide is what is government doing in terms of aiding the FMCG sector. And of course, from an auditor's perspective, it is extremely important. One is, of course, the introduction of GST, which has given a good push to the FMCG sector, considering now FMCG is now able to claim significant amount of input credits from their raw material purchases, and there have been significant amount of subsidies that government of India gives, which of course from not to the FMCG companies but to the people. But if people have some purchasing power, FMCG is the first thing that they're going to elevate, because it elevates the wage. And of course, it boosts the consumer sentiment. And of course, there is also an impact on FMCG sales from let's say rural economy perspective as to how the agriculture is doing. And you would have seen, if agriculture is doing well, which is a great monsoon, we would have seen that the demand in the rural picks up for everything. And of course, how can we not touch upon something called a demographic dividend, which India has? India has the largest youth population, which of course is the future potential for the FMCG sales, especially in the personal care arena. So the economic policies that lead to job creation with higher earning potential, this younger population will help in increasing the demand of the FMCG product. Now, in summary, if I was to say, the economic growth or the consumer confidence or the government policies and the global trend all play a significant role in determining how the FMCG sector performs, and it continues to grow its market share. Okay, now what are the India stats look like? All this thing, I feel this is to know a background of the economy linkage with FMCG is important for any auditor to understand the nuances of an FMCG audit. And that is the reason I have some 10-12 slides on this. Now, if you look at some snapshots, the Indian FMCG market was valued at around 108 billion US dollars in financial year ending 2023, and it is expected to reach to 1 trillion by 2032 with a CAGR of 28% roughly. So which means today FMCG generally roughly constitutes around 3% of our GDP, assuming that our GDP is at 3.5 trillion as we speak, and it is expected to be 9 trillion by 2030, which further would mean that from a 3% of GDP, it is likely to increase to 11.7% by 2030, which is about 7 years from now. So this is the kind of potential that this sector holds, and only because, and this is possible in India only for the reasons that I mentioned in my earlier slides. The demography is here, the rural sector, which is kind of untouched as of now, or which is yet to be explored. Now, only because of this reason, you will see that we have investments coming in, be it in the form of for FDIs or be it in the form of M&A acquisitions. This is around the year demand for FMCG products, and investment just continue to pour. And I have certain 2 or 3 examples in my subsequent slides where we've seen that those large FMCG companies like a Dabur or ITC, they have acquired some FMCG companies to increase their reach amongst the people. Now, moving on to key growth drivers, of course, we have the rising disposable income. The income in India just continues to rise. Even if we look at per capita GDP, which was roughly around $300 about 15 years ago, it is already at about $3,000 now, and it is expected to be around $4,900 in coming 7-8 years. Now, this disposable income, of course, in comparison to other countries, is extremely less. but purely from uplifting one's standard of living, uplifting one's livelihood. FMCG sector only tends to benefit from here. Low level of market penetration, I think this I've already touched. Our rural area is the area which is in focus. A young population is an aspiring population. They would want the best for themselves and for their families, which means the spending will only increase. And of course, brand awareness. With the internet coming in, there is so much of brand awareness and so much of urbanization, which in turn pushes the need for the FMCG products. Okay, moving on. Of course, I touched upon that the rural sector currently is 35%, and this is expected to cross 50% of the overall FMCG only because of the dynamics of the sheer volume. The sheer volume that is expected out of this. If you look at FDI, the government has relaxed foreign equity into single brand, which is now 100% on a single brand, 100% foreign direct investment, which means it gets 100% investments gets covered under automatic route, and 51% investment is allowed in the multi-brand retail investment. Now, which in turn would mean that the government also do understand its ripple effect on the people, on their livelihood, on their on the employment that it generates and the market that it has. And from the PLI side, as I mentioned in my earlier slide, the investments of $1.4 billion has been committed in the PLI, which includes various sectors, including the food processing. This will only go on to increase the employment, which in turn would help uplift the standards of people. This will help increase our exports, which would mean it will have a significant impact on our country's economy by saving those precious US dollars. But this is all fine, but what is the outlook of 2024? Now, again, something which is not very, very different. As I had said that the metros are generally considered to be exhausted, so the real growth will look to come from the rural consumption, and rural consumption in turn will depend on. I'm considering this is an election year, so besides a good monsoon, it will also depend on what kinds of incentives are provided to consumers by the government, and of course the impact of inflation. What kind of inflation does the country witness in the coming months? And so all these things would have an impact on the disposable income which is left in the hands of the consumer. And so now of course, the last bullet point this is also part of FMCG, but what we've seen of late is that, so this is one aspect where we talk about the general FMCG growth coming in, but there is the other aspect there, which is a luxury segment. And if we look at, when we talk of luxury segment, we talk about all those foreign imported cars, or be it the luxury housing, demand of the luxury housing and all, or let's say the top end products, even in the white goods category. So what we have seen is that luxury segment did very, very well in 2023, which was kind of a surprise to us, a surprise to many economists. And what they expect is that it will continue to do well in 2024 as well, as more and more Indians now want to upgrade their lifestyle. So how does 2024 look? So in a way, it is expected to be neutral to positive, considering this is an election year. It is more or less considered to be having a very, very positive outlook from FMCG growth perspective. Well, I'm sure all of us are already aware of this. I'll not spend much time, but because I And for to talk about FMCG, I put this slide. So generally, it is categorized. These are a high-level categorization on various companies that I have witnessed in terms of FMCG play. So you will have a sector called F&B, food and beverage sector, which is generally like food, fast food, or beverages like a Coca-Cola or a coffee or a bottled water and all. Fast food will include your bread, potato chips, or those small packages and pizzas and all. Personal care is one sector which is gaining significant growth, considering people now want to enhance their quality of living. They're focusing and spending enough time. We've seen how Nykaa is doing well. So we have all those branded shampoos and the toothpaste and the hair dyes and the cosmetics and those gaining strength. Healthcare products, all those syringes, bandages, plasters, and personal hygienes, all the toiletries, and all. So generally, when we talk about FMCG, it is categorized into these four categories. Of course, you could categorize into many other ways. You could have a retail sector, or you could the retail sectors in the fabric or in the clothing. So there could be many other classifications also. But generally, it is considered these 4 or 5 categories. Okay. Now, understanding this industry a little bit more. FMCG products generally have a very high turnover rate and are sold in large volumes. Like a toothpaste, you would have seen, it's a very, very high turnover. You would need a toothpaste probably every month or every 2 months. So it's very high turnover and large in volumes. Now, also, this is due to the competitive nature of the market and the necessity to keep prices consumer friendly. India, of course, is a very, very price sensitive market. It is extremely important to keep the prices in check. Moving on to broad consumer base, these products are typically essential items used by a wide range of consumers. This includes products like food and beverages or personal care or household, as we had mentioned in our previous slides. Moving on to low consumer involvement. Now, you would not really think that much in terms of purchasing FMCG sector. They're generally routine, or it involves a minimal consumer involvement or a minimal financial commitment. Therefore, the decision-making effort is also minimal. Now, these products are usually low priced and have a small economic backup. Now, however, there is this concept of brand loyalty. While the sector is characterized by low consumer involvement, brand loyalty, of course, can be very, very strong. And this is what the play is in terms of. That is the reason you will see there is so much of spec on the media. There's so much of advertisement of the FMCG companies coming in because they want you to have this brand remembrance or the brand loyalty. The consumer often they stick to the brand they trust and they are familiar with, especially the products that they use regularly. So unless and until they have a very strong reason, they would generally continue to have a brand loyalty and they will continue that. Short shelf life. The products have the products are perishable generally, especially the food products are perishable and they have a limited shelf life. Now, this necessitates efficient and rapid turnover in production. That means the supply chain has to be very, very efficient. The sales process has to be very, very efficient. The turnover in production has to be efficient. The logistics have to be, kind of, for the lack of a better word, up to mark and efficient. So this is the FMCG only because of the fact that we have shorter shelf life. All these factors, which is supply chain or the production or the procurement or the logistics, gain significant importance. Another aspect of FMCG industry is an extensive distribution network. Now, the FMCG sector relies on wide and efficient distribution network because the production plant may be based in the Uttar Pradesh, however, supply may be reaching to down southeast, to the down south, or in the extreme east, or in the west and all. It is extremely important that the distribution networks are highly productive and highly quick and are highly reliable. And then moving on, Of course, there is high competition and high innovation is also needed only because of the fact that it is highly competitive. There are numerous brands vying the customer's attention, which makes it extremely competitive. So the FMCG companies have to continue to invest in the R&D in the R&D sector so that they come up with something new and are found as unique in the market. And of course, last point is sensitivity to the economic cycles. We touched upon the fact that FMCG products generally would do well and are sensitive to the economic cycle. If there is a downturn in the economy, the customers might want to reduce their spending on premium or non-essential FMCG products. However, if they have a purchasing power, this is the first area where they would want to continue to make their investments. I think market size, India FMCG sector in India is the fourth largest sector in the country, driven by rising disposable income, and it continues to increase. I have a slide on how the disposable income has gone up in last 10 years or so. And of course, our population continues to increase and productive population continues to increase. And that's the reason we call it a demographic dividend. Our median age is only 28 years, which is the fact that we have the youngest population. It's not only about young population, it's about productive population. It's about the population who is earning for themselves and for the country. And of course, the divide between urban and rural is 65 and 35. I think one more area where which is impacting the FMCG is the digital transformation and the e-commerce. Now, there has been a significant digital transformation in this sector. With the penetration of internet, the user base of internet has gone up from 3.84 crore to almost 7.6 crore in 2022. And it is expected to be around 90 crore by 2025, which is next year. And of course, which would mean that almost 60 to 65% of India's population would be digitally literate, would have something to do with the internet, which means the market is in their reach. And of course, another push it gives is on the digital advertising. You have those advertisements coming in Google or in YouTube or in the Instagrams and all. It is giving a push to the digital advertising industry as well, and FMCG is a major component. Online grocery market in India is projected to grow many folds, maybe by 10 times in next 10 years or so. And you would have already seen the e-commerce is gaining prominence, which is the online grocery in the market. We have the likes of Zomato's, or maybe the likes of Blinkit and all, and then of course Nykaa and all, which contribute through e-commerce. Now, factors that affect the growth in FMCG, I'll run this fairly quickly because most of the points are covered. Disposable income, I touched upon, large population, rising consumer awareness. So as I said that now, since the reach of the FMCG market is, the focus of the reach is in tier 2, tier 3, tier 4, they would get to know about these brands. And also with the OTTs and with the access to the internet, they know as to what the outside world is doing, if not internationally, but they know how things are, what kind of things are there in the metros and all, which creates an aspiration and which further goes on to create the market. Then, of course, with the growth of e-commerce, I touched upon the conducive government policies and the technical advancement also do that. And of course, in my initial slide, I mentioned that currently it is giving employment to masses. The FMCG sector has given employment to 3 million people, which is approximately about 5% of the total factory employment in the country. The trends in the FMCG sector. So what we've seen is that the consumer behavior is very uncertain, and also we talked about brand loyalty. But how do you influence the brand loyalty? How do you see that the loyalty towards those brand changes? Of course, one is clear advertisement, and of course there are influencers. There are various kinds of ways through which uh, these companies or the FMCG sector would want to reach out to the people. Now, key trends would include rise in the convenience. They would want to offer you more convenience. They would want to offer you a more pleasant experience. They would want to offer you more expertise, and also the fact that they want to reach out to you through omni-channel strategy. The same product would be available in a retail shop, in a mom and pop store. The same product would be available in a Blinkit. Same product would be available in Amazon or a Flipkart. Or you may want to see, analyze. You may want to study more about the product, and that's how you would want to change the behavior of the customers. And then traditional trade is now getting involved, which now involves more of digital payment and more convenience. So now if the mode of the payment is convenient, the study has shown that people will be inclined to invest more, and people would want to spend more and more, because you are not physically paying out cash at that point in time. And this is what traditionally we have seen. And there is, of course, there is this noticeable trend towards experiential shopping and the rise of influencers in the digital market. I talked about the social media and consumer decision. Now, the demand for natural and health conscious choice is also increasing. Now, I had to mention this because it is really, really catching up, which in turn would mean that because people have become more health conscious, people have become more conscious of the fact that they don't need obesity, they don't want to have more sugar, they want to have more proteins, they want to have less of carbs, uh, and of course they want to have more of natural things than of the chemicals and all. The demand is suddenly increasing there, and then you would have seen that of late in last 1 year or so, these large FMCG companies have started acquiring those organic companies or natural. For example, Tata Consumer recently acquired Organic India, which is part of the Fab India group. Now, this is pure, they have a pure play into natural and health conscious choices. So, what we've seen is that now things are moving in the direction from, let's say, a more carbonated world to a more softer world, which is more natural and which is more organic. And of course, awareness for healthy snacking, which is becoming exceedingly important from FMCG sector, and companies are focusing on eco-friendly packaging, which was never the case. You would have seen that the companies are also now mandated to use, let's say a paint which is more edible now, which was never heard of in a country like India, and it was only restricted to the Western world. Now, the health snacking trend is gaining momentum, driven by further those consumer preferences for nutritionist and yet convenient food options. Now, economic and technological influences. So of course, we can't, kind of go ahead without understanding that how technology is influencing this. But the sector is adopting to the changes economic realities such as inflation and shift in the consumer spending. However, the technological advancements like the AI or the big data and the blockchain, they are becoming integral to the FMCG industries. ChatGPT has already started disrupting the retail and consumer. I don't know how many of you have recently visited Mintra, and wherein they have already started using ChatGPT in the form of an assistant. For example, if you kind of ask as to what can I wear in for this marriage function, and if you put in more details, it will actually throw as to what would be a recommended outfit for you for that particular function and lot. Internationally, Walmart has started using to manage unnecessary returns of the products through the use of ChatGPT or use of the artificial intelligence. So it is only here to stay. It is only here to increase the experience, enhance the experience of the user, which in turn would result into the sale. Now there is this new concept, D2C, direct to customer brand. What exactly is D2C? So by definition, direct-to-customer brands are companies that sell their products directly to customers without going through the traditional retail channel like a departmental store or a third-party retailer. Now, this business model has gained significant traction over the past decade due to the rise of e-commerce and social media marketing, which allows branding to interact directly with their customer here. Now, uh, so primarily, this helps in cutting down the margins for the retailers or margins for the middlemen in between, and that margin could ideally be shared between the ultimate uh, retail customer or with the company, or it could be given completely to the retailer. So, which in turn would is giving a big challenge or big competition to the retail stores. And this, of course, the main product for D2C is the FMCGs. India advantage. So, of course, we touched upon many items which talked about the India advantage. Now, if we uh, see as to what has really impacted the advantage for the FMCG sector. Now, this is the slide I was talking about. You would have you would see that in 2016, the GDP per capita income was around 1,700 US dollars, which is already around 3,800 US dollars. Uh, this has significantly, and this is besides the fact that our population has grown significantly from 2016 to 2023, and it continues to grow. Probably it will grow till 2045 or so, and then it will probably stabilize. But if you look at 2045, of course, the India's GDP growth from a 3 trillion or 3.5 trillion now, it will move to around 9 trillion by 2030, and which will be roughly around 40 trillion by 2047. Of course, this is based on certain premise that we have the largest working age population, which is expected to only increase by 100 million from, let's say, now till next 5 or 6 years, which will add on to the productivity of the country. And of course, you would have seen that the growth in India is somewhere ranging between 6.5 to 7 or 8%, and the projected growth is also around 6.8 or 7%. Basis this fact, this has a significant impact on the disposable income, and then the disposable income would further translate into the growth in the FMCG sector. It's not only about the people's income growing, there is a significant push, let's say, from the government, as I'd already covered. I very quickly run through. You have a PLI scheme introduced by the government of India, which basically talks about the so the total is about 1.4 billion, out of which, if we specifically talk about the food processing, it is about 970 million. And then, of course, I've mentioned it goes on to increase the digital advertising, which in turn boosts the FMCG further. I talked about the recent investment. I talked about Tata Consumer picking up Organic India. There are a couple of other examples in this. ITC picked up Sprout Life Food, which is again a D2C startup company. And I mentioned about the fact that people are now becoming more health conscious. So you would see company like ITC, which is famous for their cigarette brands and all. They have also realized as to in which direction the Indian FMCG company is moving, and then they have acquired this. Recently, Hindustan Unilever went into a foray of health and well-being category, and they acquired Oziva and well-being nutrition. So this is this is the direction where you would see the larger FMCG companies are moving to, because that's the future. And of course, there are attractive opportunities coming in. I talked about foreign direct investments coming in. There is so much of online retail. There is so much of e-commerce. There is so much of penetration in the rural area, which is yet to be explored. That's the market. That's the market for. This is what any foreign investors is witnessing. And of course, policy I talked about. I'll move on to the next slide. Of course, there has been the FMCG sector. There has been a great evolution, and with the favorable policies, it is only going to increase. And e-commerce primarily, which accounted for 17% of the FMCG sector, is likely to increase many folds. Many folds. I think I'll move on. So I think this is I'll just touch upon the ratio is 35 to 65, and in rural, of course, it continues to be dependent on a good seasonal harvest and improve liquidity in the hands of farmers. Of course, Government of India is trying their best to change this and have more spending powers, but as of now, it continues to be in that arena. And if I was to quote the importance of this, I would want to quote an example of Nestle, where Nestle, as per their annual report, they've said that Nestle India plans to expand its reach to 120,000 villages by end of 2024. Only because of the fact that they believe that the next growth is sitting in the rural area and not in the urban area. And of course, you have Dabur, who, again, as per their annual report, their 50% or more than 50% of the sale comes from the rural area. That is the area which is very significant and important for them. And again, if I take another example, you have I talked about the good harvest. Good harvest is something which government is trying to curb by providing more subsidized fertilizers and all, only to increase the spending in the hands of people. Internet penetration. And the e-commerce. So we all talked about e-commerce in our previous slides, and then the India's e-commerce industry recorded a 36% growth in 2022, and the total value of digital transactions stood at 300 billion, and which is projected to be around 1 trillion in 2026. This is the growth of e-commerce, and you would have seen you will see in this diagram. In 2020, the online users were 622 million, and the e-commerce market was around 38 million in 2025. So currently it is around 68. It is somewhere around 740 or so. It is expected to be around 900 in the next year, and the e-commerce market will move up 4 times in the same period, whereas the online users probably would increase by a third. So that's the kind of CAGR is what the e-commerce is really looking at. Now, policy play, of course, we talked about GST and impact of GST on the FMCG, which is all positive. They've been able to claim those input credits. On the income tax side also, there have been the food processing sectors, the government has permitted deduction of 100% of profit for 5 years and 25% of profit for next 5 years. In case of agro processing industry, there has been a cut in the excise duty from, let's say, 16% to completely waived off in certain industry. And in certain other industry, they have reduced the excise duty rate from 16% to 8%. So there is a significant push from the government also in terms of regulators just to increase the FMCG. We have the FDI I talked about in the retail single brand. It is 100%. Multi brand it is 51%. Setu scheme, I just put it here. We picked it up from ISB. This is basically a 1,000 crore scheme being set up initially by Niti Aayog. Primarily, this program was designed to support all aspects of the startup business and other self-employment activities, particularly in the technology-driven areas. Fine. Now, finally, we move to the audit. With this background, let us now see as to what are the key aspects of audit in the FMCG sector. Regulatory compliance. So, of course, we touched upon how the government is aiding and how the FDI is flowing in the country and how the e-commerce will have a significant impact and how the rural will only increase and how the M&As have impacted the FMCG sector. So with this background and also the fact that with the increase in the disposable income, the FMCG sector is standing first in line to benefit or gain from this. From an auditor's perspective, it becomes an onerous responsibility onto us. It becomes an imperative responsibility onto us that we understand the industry, we understand the sector, and then understand the nuances and plan our audit procedures accordingly. So from a regulatory compliance perspective, this FMCG sector is highly regulated only because of the fact that FMCG sector is generally dealing with either human skin or with human products for the consumptions of human edible products. So it has to be, there's no way out of it. It has to be a highly regulated sector. And of course, there are complex web of laws and regulations. So auditors should need to have, you need to be aware of the latest changes in the legislation and ensure that our clients are also in compliance. Now, all of us would recall NOCLAR, which is of course applicable for listed entities as of now. But any non-compliance on any law would have a financial impact. So from an auditor's perspective, one has to understand that it is not only about the income tax or a GST or let's say some other fiscal benefits. We are also talking about other laws which touch the FMCG sector. So therefore, emphasizing the importance of compliance with local and international regulation is important. Now, this includes adherence to the food safety standards. I also talked about quality standards and how do you measure it and environmental regulation. FMCG compliances are subject to a range of regulations due to their direct impact on human health. Now, this includes adherence to good manufacturing practices or HCCP or OSHA regulations and all. Now, there could be other, so this is one aspect which we probably would want to understand more because it will have an impact in terms of the FMCG, how the company is doing, and also finally would have a financial impact. And there are other factors which include like a labor or a financial taxation, environment, health and safety, or which are certain other industry specific matters. So we on a very high level we touched upon the benefits which the government has given primarily more on the GST side, and also on the excise duty side. So basically, if you move on further, you will have Make in India initiative. The government's Make in India campaign offers various incentives for manufacturing within the country. FMCG companies setting up manufacturing locations may avail those tax exemptions or duty-free import for certain components and other benefits in the initiative. Now, if you put up your plant in a SEZ, now those companies setting up operations there can benefit from some tax holidays or from some duty-free imports or simplified procedures. And these advantages can be taken by the FMCG companies. R&D incentives I talked about, the companies investing in the R&D activities, government wants to encourage it. That's the reason they have given these tax benefits, tax incentives to encourage innovation and development in the field of FMCG. You have those R&D benefits available. Now, there are certain state level incentives, like different states in India offer various incentives to attract industries, including FMCG sectors. This would include some subsidies for a particular area or some tax exemptions, some subsidies for a GST or assistance in setting up some infrastructure, some capital advances. And then the export incentives I touched upon, and some credit-linked subsidy schemes can also be offered. It could be central scheme, it could be a state scheme also. And FMCG companies have taken benefit both from this scheme and from PLIs, from export incentives, from R&D schemes, all those schemes that I mentioned about. FMCG sector has taken advantage of this. Okay, moving on from a financial reporting and analysis perspective. Of course, revenue, Sanjeev sir also touched upon. There is this always dichotomy on net of sales, net of what all would be netted off against these sales, besides the sales return, of course, and what are those other adjustments. So I will touch upon the broad theory behind this. Of course, we can't have a complete list for this. And how is the gross margin analysis, which is an extremely important factor in an audit of an FMCG company. Inventory management, Sanjeev ji talked about, and then because this has a direct impact on the profit margins and on how the inventory is to be audited, both from a valuation perspective or from existence perspective, from accuracy perspective, almost. Now, besides that, there would be those technology and data security, where the focus on the use of technology in the FMCG companies, including the importance of data security and IT infrastructure. Now, given the increasing reliance on digital platform, auditors should or have to evaluate the adequacy of cybersecurity measures and data management system, because it is all about volume of data. It is all about data spread across the length and breadth of the country. How does an auditor? There are lakhs and lakhs. There are maybe million of entries passed in a large FMCG companies. It is virtually impossible for an auditor to capture a reasonable size, and that's where the data security thing comes in. That's where the ITGC comes in. That's where the big data and analytics come in. And then moving on to the market dynamics and consumer trends, auditors should have an understanding of the market dynamics and consumer trends affecting the FMCG sector. I think I've built upon enough, in my previous slides, as to how the consumer behaviors have changed their preferences, how the competition analysis is done, and what is the market share assessment. Corporate governance and ethics, I hope, I understand I'm assuming that we all will understand this very well. Address the importance of evaluating the company's corporate governance practices, now including ethical business conduct, transparency, and adherence to the corporate social responsibility principles. ESG, environmental and social impact, this is the buzzword, this is catching the eye of the day. Now we need to discuss the need to audit the company's environmental and social impact, including sustainability practice, waste management, and how the community is being served. Digital transformation, the FMCG sector is undergoing a digital transformation. Also, we discussed that the company increasingly uses technology now to connect with their customer and improve their operations. The auditors need to be able to help their clients navigate this transformation and ensure that they are. And when I say help, I mean by adding value through review of the controls of those digital platforms, through use of technology in a way which is more efficient and which is more efficient, which is more effective, which is more efficient. So if client has a digital platform, we would surely need an auditors expert in our team who understands that technology, who understands information technology, who understands the weakness sitting there, who understands segregation of duty, who understands the logics sitting there in those digital media or the softwares. Now, if we very specifically move to certain key areas, the biggest one is the procurement. Now, if I share basis my experience, so in an FMCG, of course, what is there in your hand is production. If you have raw material, you will of course products. But what is not there in your hand is the procurement, because procurement, you are dependent on your suppliers, you are dependent on the raw material price, you are dependent on the fluctuations, you are dependent on the commodity prices and all those things. And so this is one area, both from a FMCG industry perspective is important, and also from the auditor's perspective. Procurement is as important as a revenue in an FMCG setup. Now, effective procurement is vital for FMCG companies. It involves selecting the right suppliers, managing relationships, establishing control levels to minimize the risk, and choosing appropriate technology to support procurement process. It is important to align procurement function with company's overall strategy, whether through centralized or decentralized procurement system, and to focus on collaborative strategic sourcing. So whenever any procurement is done, it has to succeed the overall strategy of the company. If the overall strategy of the company is to, let's say, maintain a 20-day inventory, or they believe a potential sales coming up, potential season coming up in next 3 months, 4 months, and this is the anticipated sales. Because you can't have your orders first and then you produce, it will become too late. So it is extremely sensitive, it is extremely important and dependent on how the procurement functions or functions in a company's overall strategy. Performing a procurement audit in a large FMCG companies involve a systematic examination of the company's procurement policies, company's processes, company's transactions to ensure compliance, efficiencies, and cost effectiveness. Now, there are key audit procedures which typically would involve in a procurement process. One would see that you would want to study the process, you would want to draw up a proper risk and control matrix chart, you would want to see what are the kind of controls there, you would want to see what is the basis of selection of suppliers, what is the basis, what has been the past trend of the supplier, has there been any issues with the supplier, both in terms of financial and non-financial. When I say financial, I mean, has there been any financial misreporting by the supplier, or has there been any qualitative issues there? So several things could go wrong, which auditor needs to be vigilant upon, and then things could range from operational inefficiencies to outright fraud through the suppliers, and all those things would need to be looked out for. So after supplier selection, we move to the contract management issues. Now, a poorly negotiated contract may not be in the best interest of the company or lack clear terms and conditions. So once you identify the supplier, you have applied your non-competitive supplier selection, you have identified whether competitive quotations were there, proper diligence was done by the company, and there are no unethical practices identified, you move to contract. The contract also, you need to ensure that it is in the best interest of the company and the contract is competitive, and the auditors would need to scrutinize that. Kickbacks and bribery, so procurement fraud. This is what we've generally seen is quite prevalent in any procurement company, be it FMCG or non-FMCG company. So there is this kickbacks because the purchase manager or the purchase team have that significant power in terms of placing the order. So one needs to ensure first understand what the process is, then the auditor need to consider this as a risk. There could be collusion with supplier also, there could be bribes, and there could be inflated costs which lead to procurement of substandard goods or creation of fictitious suppliers or invoices would mean embezzlement of funds. So auditor need to be conscious of this unusual payment pattern or relationship with the supplier that lacks transparency. So you have to be skeptical. You have to understand that this is a risky area. Unauthorized purchases or conflict of interest, the purchases made without proper authorization or bypassing the established procedures, use of companies' funds for personal purchases disguised as legitimate business expenses. So all those auditors would need to check to the adherence of authorization metrics to investigate any anomalies sitting there. Conflict of interest is generally kind of seen where, let's say, the vendor is a related party to someone in the purchase department, and those, because of that personal relationship, the benefits are rather passed on to the vendor, and then it falls into the category of unethical, or one could also categorize in the category of fraud. So auditors should assess the procurement process and also see the conflict of interest and ensure that there is a clear policy in place which is to be valid. Inefficiencies and waste, this is also another area which needs to be taken care of by the auditor, which means it lacks competitive bidding or comparison shopping. If there is no competitive bidding or if there is no comparison shopping, this means this is a clear indication that there could be an overpayment for goods and services. There could be unnecessary or redundant purchase that contribute to the waste. So all these things are forming part of what an auditor should be wary of in terms of procurement. So auditor has to be skeptical in terms of all this. I think controls I touched upon, understanding and evaluating the procurement process. Then important to assess the roles and responsibilities within the procurement department to ensure a clear accountability and segregation of duty. It is critical to evaluate the effectiveness of controls over the procurement. So it is just not the walkthrough of a control. You will need to test the design. You will need to do a walkthrough. You will need to test the effectiveness, operating effectiveness of those controls. Moving on to verifying the price and cost analysis. Now here again, a detailed analysis of pricing structure should be done to ensure that the company is paying a fair market price, and which if this is competitive, if there is a competitive quotation, then at least there is a demonstration that a fair market price is being paid. And it is also important to review the cost saving measures such as bulk buying or early payment discount, whether this has been evaluated from a bottom line perspective. Okay, moving on to evaluating the procurement performance. Anything which is not evaluated means that it is not tested. Further would means that those KPI and those matrices are not put to test, which means the control may have failed and there is no evaluation done. It is important for auditors to review whether the procurement department is effectively meeting the company's objective and contributing to the overall strategy. It is necessary to review any unconventional spending or any deviation from standard procedures, as they could indicate potential inefficiencies or issues within the procurement process. So everything and anything, you need to analyze the risk. You need to draw up your controls. You need to see the significance of the control for the company, and then think what could go wrong. If this is not done, what could go wrong? And then try and focus your energies there and be more skeptical there. Okay, inventory. From procurement, we move to inventory. Inventory, of course, the most important thing. But before we start, let me start by mentioning about inventory management failures first. Now, there could be a situation of overstocking or understocking. This could be due to poor demand forecasting or procurement plan or poor procurement planning, leading to increased holding cost or stock out. Now, this is a starting point for an auditor to dig further. So any of these criteria would mean that there is, of course, weakness in any control, in some control or the other as part of the procurement or as part of the inventory management. So if there is, of course, overstocking or understocking as compared to the company's internal benchmarks or as compared to the industry benchmark, that's your starting point. Now, moving on, of course, you have physical inventory count to focus on perishable goods. While you are performing observing a physical inventory, have a focus on the perishable goods. I mean, you can't value a perishable goods which is about to expire in 3 months' time, 4 months' time, 6 months' time, unless and until there is a clear plan. Of course, I'm not giving a diktat. It is, I mean, that is a red signal. That is a red flag for you. That has to, that has to create some anxiety in the auditor, because this could be a potential impairment of inventory sitting there. Analyze the input-output ratios. Now, this involves evaluating the efficiency with which a company converts its inputs into outputs. Input can include raw material, labor, overhead, while output are typically those of finished goods. input-output ratio is a measure of productivity and operational efficiencies. Auditors might look at the ratio to assess whether there has been a significant change over time, which could indicate issues with production processes, supply chain management, control, or fraud. So let's say your input to output, if that is not controlled, and even the slightest of, basis my personal experience, even the slightest of impact in the input output could have resulted on account of a fraud. So I mean, it is not as simple as putting, let's say, 10 units of RM, giving out 10 units of finished goods. There could be thousands of factors impacting our input output. So therefore, one has to really compare it with the company's benchmark, what they have set, and what are the reasons for variation, and whether the company's benchmark itself uh, are how do they stack up with the industry benchmark? That's extremely important. And this is the fraud risk area, to be honest. And then there could be other turnover ratios within the industry benchmark or historical company data. So comparing these ratios within the industry benchmark could provide an insight on how well the company is performing. And so all these are done to identify the triggers for you. Now, historical company data comparison help in identifying trends, patterns, anomalies over time, then improving the turnover ratio trend could indicate better management and operational improvement, while declining trend could be other way around, which could signal potential problems. So in conducting these analysis, the auditors can identify an area where the company may need to improve efficiency or address potential issues that could impact the financial performance. And then this is the area where you start drilling down in terms of why this has happened. Is it genuine, or there are other control weaknesses sitting there? I talked about provision in the beginning. So you have to evaluate the adequacy of the provisions made for inventory shrinkage and loss. It has to make sense. It has to be consistent. It has to, you should have some demonstration of how that estimate has been arrived at, and that estimate has to make sense to an independent auditor. Then review of historical trends and consider the needs of the adjustment, and also assess the consumption pattern. So let's say there are companies where who create obsolescence provision basis the consumption pattern. So let's say you have inventory lying for 3 years, whereas inventory lying, let's say 100 units of inventories are lying, which will get consumed over a period of 3 years. So that means in next 1 year, a third of it will be consumed. In the next year, again, 2/3 will total will get consumed. And then now compare it with a shelf life, or let's say whether there would be obsolescence or no. And that's how then you create a provision. So the consumption pattern is also something very important in terms of inventory held by the company, and then whether it needs a provision. Rev rec. Okay. Okay. Now, so of course, on the face of it, if we start, it looks very simple. You make the sales, you credit sales, you debit debtor, or you debit bank, and that's it. And then the things end. But of course, if we dig deep, if we go through India's 115, IFRS 15, or the US standard, let's see 606, we will see significant components of adjustments on the top line. Now, but before I touch upon to that, let us try and understand in an FMCG company what would be the various channels of sales. So first and the most significant is the sales through distributor, which is also called the primary channel of sales for FMCG, which is of course through a network of distributors. You sell to a distributor or a stockist would sell to a distributor would further sell to the retailers would sell to the customers. Now, sales are typically recorded at the point of transfer to the distributor, and note that the revenue may need to be adjusted based on certain schemes, and which could be volume discount, promotional activities, or market development. So let's say if you have a volume discount coming up, you need to create an assessment as to how much will be the volume discount during the tenure of the scheme, or during which the total volume has to be picked up. whether there is any promotional scheme. Let's say, just to quote an example, a beverage company would want to come up with a scheme in the month of January, February, March, where they are catering to the season starting from April. They would want more of, let's say, for example, they would want a PepsiCo would want more of Pepsis in the market rather than a Coca-Cola or a Thumbs Up. So they would want to come up with schemes so that there is larger uplift by their distributors and hence more penetration in the market. So one would need to see what kind of schemes are there, what kind of volume discounts are there, what kind of market development funds are thrown in the market. So we will need to see as to what kind. Generally, all these are adjusted in the sales value, which means sales would be shown as net. There could be various types of incentives which are often provided to the distributors based on volume I talked about. And again, this could be in the form of rebates, or this could be in the form of discounts, or the timing of recognizing this incentive may affect the revenue. So let's say, for example, there could be a yearly scheme, and the yearly so you would need to estimate and if there is a year end, let's say the year end is December and the yearly scheme ends in March. So you would need to estimate how much will be the payout for the scheme, and that estimate needs to be topped up once the actual numbers are available. And for the year end, of course, that estimate needs to be reduced from the sales. The second type of sales, the first one I talked about is through distributors. The second one is through sale to the modern trade. Now, these are basically sales to those large stores. We call it Reliance Retail, or those kinds of large stores are there. The sales are through retail chains, which are often. But the issue there is the contracts are very complex. So one needs to understand the contracts. One needs to understand the what are the terms and conditions for sales returns, what are the adjustments for that, what is the quantity discount there, what is the pricing. There could be step up pricing, there could be who's going to be the freight charges, who's going to be the storage charges, are there charges for putting in the front row in the shelf. There could be many kinds of charges in modern trade. One needs to go through the contract and see what would generally get adjusted from the sales. The third category is sales through e-commerce platform. Now, again, in the e-commerce platform, again, of course, this is a growing segment, and we've discussed this in our earlier slides. But there could be financial considerations of warehousing cost, for example. For example, a Flipkart or an Amazon may requires goods from you and put it in their warehouse and charge a warehousing cost to you. So you will have to see what kind of contracts are there and what kind of services are there in green. They may also want to charge something. So let's say if you search in an Amazon app or in a website, and if the company's product flashes first, so there could be additional charges for that. What are those charges for? So those charges, whether those charges are net of revenue or those charges are marketing expense, media expense, what are those? So of course, there is no right or wrong answer. Generally, these are more tilted towards netting of revenue, but there is, again, as I said, it will purely depend on the plain reading of the contract and link it with the India's 115 as to how the contract would work. Moving on to sales discounts and rebates and allowances, I think I touched upon that. Now, of course, there are enough literature available in India's 115 or ASC 606 or IFRS 15. It is important, and as I mentioned, it is important to adhere to the appropriate accounting standards for revenue, primarily on account of the stages of recognition, the cutoffs, the netting off, and then the obligations, the variable interest, the variable considerations like discounts or returns, and then the provisions accordingly, and then the netting off. So essentially, we have seen that there could be complex adjustments to the revenue recognition in FMCG sector. Therefore, it is necessary to have a robust understanding of the system and the contract to have a complete accuracy on what you report as revenue recognition. Okay, we touched upon procurement, we touched upon inventory, we touched upon revenue recognition. Now, supply chain. Of course, this precedes the procurement. So one may want to put this under procurement, but very quickly running this through, the auditor have to have an overview of the procurement process. I think have an overview of the design, have a testing of the operating effectiveness, have an understanding of the risk associated with logistics and distribution. Now, supply chain could work both ways. It means supplying to the distributors and also supplying raw material back to the factory. Now, this can have a significant impact on the FMCG company's operation and the financial performance. The audit should identify the controls that I had already mentioned and then analyze what could go wrong. So let's say there could be delays in transportation, it will have a ripple impact on the complete production cycle and also items which are reaching to the customers. So this is extremely important. You will have to analyze the loss of goods, the damage during shipping, what are the terms and conditions there, fluctuations in the logistics cost, because that generally would tend to arise some professional skepticism in you in terms of understanding as to why there have been fluctuations in the logistics cost. And then, of course, the insurance coverage cost, because that may also determine in terms of where you may want to book the cost. Moving on to efficiencies and compliances in the supply chain. Of course, if it is so any efficient supply chain mechanism will go on to increase the profit margins of the company. So that is the reason it is important to focus on the compliances. It is important to focus on the compliances, ensuring company adheres to the local and regulatory requirement, especially in the areas such as environmental standards, labor laws, or in the custom regulation. So you've seen that it is necessary to have a proactive approach to managing supply chain risk and maintaining operational efficiencies, which in turn would determine the behavior of as to how those things are looked into, what kind of controls are there, what kind of operational efficiencies are there, and which in turn would have a bearing on your risk assessment. Okay, regulatory compliances and reporting. In the audit of regulatory compliances and reporting of an FMCG company, several issues could arise. Now, the auditors should be or have to be aware of those potential problems. Now, any non-adherence to standard, as I told you in my previous slides, there could be a no-clan if you are performing the audit of a listed company. If you are not performing the audit of a listed company, then there is this SA 250, I guess, which basically talks about laws and regulation. How do you comply with that? And then there could be a financial impact. So there has to be a clear understanding as to what is impacting the company. Inadequate documentation is of course is a curse to any auditor. Now there might be insufficient documentation that demonstrate compliance with the regulatory requirement. Now this makes it challenging to verify the company whether the company is following any legal or regulatory guidelines. Now this is something which can't be left without any focus. So this needs to be brought into the attention of the necessary TCWG or the stakeholders. Moving on, lack of training. One needs to ensure that the employees are aware of compliance requirements, and this can only happen if there are sufficient trainings, if there are learnings, and which primarily is leading to avoidance of non-compliance. There may be instances of bribery or corruption. Now, how do you tackle that? There could be certain laws like an FCP or a UK Bribery Act. One needs to be aware of the fact as to which company, what is applicable, and there could be repercussions flowing out of the FCPA or the UK Bribery Act or the Indian PMLA Act, and then basis that necessary provisions for the cost needs to be plugged in. Supply chain compliances, the company may not adequately verify the supply chain compliances or relevant regulations, again, which may have a direct impact on the status. So these are certain high-level categories where the compliances is needed. I think in the initial slide, we talked about technology in the FMCG sector and the role of technology in the FMCG sector. Now, it is only increasing, gone are the days, both from the company's perspective and from the auditor's perspective. For these slides are more from the auditor's perspective. Now, technology is an integral part of an FMCG operations, driving efficiencies and innovation. The system should be such which should encourage integration to the core business process of the real time, provide data analytics to the market and consumer insight. Now, generally, any FMCG company would want to have that kind of automation or an AI. Now, from an auditor's perspective, the auditors should, or let's say the auditor's expert who is a CISA or a DISA should have adequate experience in the IT systems and cybersecurity measures. It is extremely important to audit the IT systems to ensure the data integrity, operational continuity, and security. Auditors need to evaluate the adequacy of controls around IT systems, including access controls, data encryption, or regular security assessments. Also review the need for the cybersecurity framework to protect against data breaches or cyber threats, and any other data protection regulation. So one would also need to see whether there are DRPs, which is disaster recovery plan, BCP, business continuity plan, to safeguard against the IT system failure. So the companies are increasing the complexity in terms of their digitization or automation. So from an auditor's perspective, this is the kind of response that is needed. Now, of course, there is impact on the technology, on the inventory and sales tracking. Now, from the company's perspective, the companies may want to use RFID tags or automated recordings, automated reordering systems or real-time checking or reduction, reducing the incidence of the stockouts or overstock. Now, from the auditor's perspective, one would need to again have an understanding of the logics sitting within those softwares, have an understanding of the interface with the main software, have an understanding as to how the audit trail is sitting there and how the technology is enabling the accurate sales forecasting or dynamics pricing, leading to the impact on the financial statements. I can't really stress more on the importance of increasing technology and digitization and data analytics in our audit, especially in an FMCG environment where the volume of data is really, really huge. Okay, so while I was preparing this presentation, I thought that it is only important for our colleagues in the profession to share some thought process on areas which are more prone to fraud in an FMCG company. And let us see how. Inventory management, of course, is now there are complexities in managing large volume of products, and that too at the large locations, which increases the risk of mismanagement of them. Now, in a retail company setup, the inventory discrepancies can arise from shoplifting or employee theft or errors in record keeping. Therefore, it is only important to have a continuous monitoring and, of course, to have a regular stock audits, proper inventory control, and security measures to mitigate it. And this is a very, very realistic risk in terms of an FMCG. Supply chain management. Supply chain management and procurement, I mentioned kickbacks, I mentioned bribery. Now, these are very, very realistic risks. So there is a need for thorough vetting of suppliers, competitive bidding process, whether that process is working fine, procurement of monitoring of procurement activities. Monitoring is also important. Setting up the processes is half done to prevent this kind of fraud. Sales and revenue reporting. Now, if there are targets, then there may be a chance, because then there is an incentive to record sales at an inflated level and manipulate the revenue recognition to meet the targets or not. Of course, such practices would lead to serious legal and financial repercussions. From an auditor's perspective, if the value is more than 1 crore, it leads to a reporting under 143(12) in ADT 4 form to the central government. So one needs to have a robust process in terms of how the revenues are recognized, what are the cutoff procedures, and whether there are. So there could be cases of channel stuffing. One needs to understand what channel stuffing is and how that. To curb that, to audit that, one would need to see whether there are sales return immediately after the year end. Or let's say 10 to 15 days after the year end, one would get to know whether there was a channel stuffing or not. And then expense reimbursement. What we've seen is that there could be issues of fraudulent expense claims. Now, this could lead to an overstatement of fictitious expenses. So, from an auditor's perspective, of course, verification of receipts and try and doing a little bit of proprietary audit in terms of why was this expense needed? Does it make sense to the company's operations? A little bit of that is needed. So gone are the days where you would just tick it and move ahead. It has to be a thinking audit. It can't only be a ticking based audit. So marketing and promotional activities. Now, again, this is a high risk area of misappropriation of marketing funds, such as diverting money intended for marketing activities into personal account or spending on non-approved activities. Again, the audit procedures would need to be designed based on what got approved, what are the contracts, who are the players. The players have to be significantly large players in the market, who should have a good name in the market. All those procedures would need to be performed. Distribution channels. Now, corruption or fraud in the distribution channels could involve illegal diversion of goods to unauthorized sellers or excess. Now, again, it is suggested to implement a tracking system or a regular reconciliation with the distributor and audit the distributor also to ensure that the goods have reached to the intended destination. There could be issues in product returns or warranty claims. There could be false warranty claims to defraud the company, or there could one may claim a warranty. So there has to be some mechanism in order to ensure that those warranty claims are genuine, those sales returns are genuine, and then there is a verification process, and it is not just written off that easily. From a financial reporting perspective, it is critical that the financials are not inaccurate. Financials have to be accurate. It is very important to adhere to strong accounting policies. Accounting policies have to be consistent. Accounting policies have to be reviewed. There has to be a logic if there is a change in the accounting policies. The frequency of financial audits will only increase or have to increase going forward. How is the overall environment in the company? It has to be more ethical. It has to, what is the tone at the top? So all those things one would need to take care of. So as a recap, if I do, I can't really emphasize more on the vigilance or the strong internal controls and a culture of integrity, which is essential in preventing, detecting, and responding to a fraud within FMCG organization. The cost of fraud extends beyond financial loss, as it also includes legal repercussions and damage to the company's reputation. So it is extremely important to focus there. Okay, so as a quick case study, now of course there's no, it's not a kind of something new. We already know this, but just as a refresher, when a global FMCG company is faced with challenges in managing and valuing the inventory across multiple countries with different tax regimes and all. So challenges kya hai? Inconsistent inventory tracking or difficulty in valuing inventory due to fluctuation and challenges in adhering to various tax regulatory. Now the answer is very, very simple. I mean, there is really nothing. It is only that we do a consistent, of course, automation is one answer, so that it can be verified, the logics can be verified both by the management and by the auditor, adopting consistent policy across the globe so that the inventory valuation is standardized, and then engaging local teams there to do regular audits, regular checks. And of course, this will result into improved accuracy for the valuation, enhanced compliances, and giving comfort to all the stakeholders. Be it regulators, be it the independent directors, be it promoters, or be it the auditors also. So sometimes the solutions are simple, but we need to push it hard to ensure that we get enough comfort. Again, in this second case study, now FMCG setup experienced a rapid growth and expansion, leading to complexities in revenue recognition due to diverse revenue streams, including direct sales भी हो रही है, online sales भी हो रही है, third party distributor भी हो रहा है. What are the challenges? Difficulty in tracking and auditing sales returns and discount. कौन सी sales return कहाँ से आ रही है? What are the discount? कहाँ चल रहा? Ensuring accurate revenue recognition timing in accordance with the accounting standard, because there are many streams. And then managing the risk of overstatement of revenue due to aggressive growth sales target. So again, you will see the solutions are very, very simple, very simple. It says implementation of advanced sales tracking system integrated with the company's accounting software, training to the staff in terms of when the revenue is to be recognized, what are the requirements of IFRS 15, conducting quarterly audits to closely monitor the revenue recognition policies and to see as to how the revenue is being recognized. Again, you would see the outcome would be that there is enhanced comfort on the accuracy of the revenue recognition. There is improved compliances in the of the accounting standards and reliable financial information to the stakeholders. Okay. Now there could be some specific situations. Let's say, what do we do in a retail store kind of environment? Now, FMCG company can present several unique challenges. Now, let's say, for example, retail store. Now, outline the processes. What do? We always start with the process. So outline the processes involved in the retail outlet, the retail audits, and monitor. The process has to talk about how the sales volume are monitored, how the stock is monitored, how the promotional activities are monitored, how the competitor analyze this, and what are the kind of compliances, uh, planned with the merchandising. And of course, how is the cash collected and how is the deposit cash taking place with the bank, and how is it recorded in the books. So once you have an outline of all this, you will clearly get to know. Then you have a complete picture from cradle to grave. You will have a complete understanding as to how the retail store is working and what is the time of your recognition, how much provision you would need for a sales return, where is the cash moving, how is the inventory moving, how is the inventory incoming, how is the inventory moving out, what are the stock transfers. Everything you'll get to know. Now, promotional activities. The FMCG companies frequently engage in promotional activities which can complicate the revenue recognition and inventory valuation. So auditors have to ensure that the promotions are accounted for correctly and verify its impact on the sales incentive discounts and which I touched upon while we were doing the revenue. So everything you will have to first rule out whether this has an impact. Is it a kind of a discount or an incentive or a rebate? Whether this has an impact on the revenue recognition. Supply chain complexities. Now, FMCG companies often have complex supply chain with the multiple layers of suppliers and distributors. So auditors need to examine the controls within the supply chain, assess the risk associated with the supplier, and ensure that the transactions are recorded accurately. Again, understand the system, identify what could go wrong. Shelf life. I think I touched upon this. Shelf life is extremely important. And then analysis as to what is the projected time of their consumption. Then multi-channel distribution with products sold through various channels, retail or direct to customer or online. Auditor must ensure that the sales and inventory are accurately tracked and reconciled across various channels. Foreign currency transactions. The auditor need to assess the risk associated with the foreign currency transaction and the impact on its reporting. So what could be the risk if it is inventory, then inventory needs, then you have to understand the fluctuation and inventory needs to be valued accordingly. Moving on to e-commerce operations, then understanding of the controls over online sales, how the online sales recorded, are there any lacunas there, identifying the security of transaction, customer data privacy, so all those things are important. Product return, high level of product return can be common in FMCG. And as auditors, we need to ensure that returns are properly accounted for and are related and physically verified so that it rules out frauds. Okay, moving on to the last slide. Now, as conclusion, as we look forward to the future, the FMCG sector is poised for transformative changes with auditing practices evolving to meet new challenges and leverage the technological advancement. So, of course, it is only the technological advancements which has to be considered as the future for both FMCG as well as the auditing for the future, auditing for the FMCG. Now, what could be that future landscape and trends in the FMCG audit? First is the data analytics and big data. So auditors, I talked about the large volume of data. What is the right sample? What are the exceptions sitting there? Unless and until you do a data analytics, it is of no use. I mean, performing a check of 120 samples over 10 million is not going to give comfort to anyone, let alone the stakeholders. So you have to have data analytics tools. You have to have big data tools that analyze the big data, which will enable real-time analysis and trend identification, which will allow the auditors to predict potential areas of risk. Automation and AI I talked about. This will transform the traditional audit task and automating the routine processes, reducing the errors and freeing up the auditors to focus more on complexity. So let's say, for example, if someone's using data snipper, one out of there, so it basically does all the clerical work, populates, and then the auditor populates in an Excel or in a Word, and then the auditor can actually verify the data in the PDF format with the actual. Focus on cybersecurity. The less said, the better. This is the highest risk that not only the FMCG companies, the country is also facing. So, so there has to be a protective environment. There has to be a complete cover around how the data is protected and how the cybersecurity may impact. And then continuous auditing. I think in any case, we have those 3 limited reviews and 1 full scope audit for the listed companies. I think time has come where the concept of continuous auditing, the things will move in the direction of continuous auditing, only in order to ensure that we have more comfort. As final thoughts, the auditing profession must embrace these emerging trends to provide valuable insight and assure stakeholders of the integrity of FMCG company. As auditors, we need to stay ahead of the curve, which can only happen with the adoption of technology. That's all. Over to you, Taneji. I'm happy to take questions.
Thank you. Thank you so much, sir. Can you hear me?
Yes, sir. Yes, sir. Yes, very well. Yeah.
Thank you so much, sir. You have covered all the aspects of this FMCG sector. So we have received certain questions. We are having with us our 2 moderators. So may I request Komal Madam to please start the proceedings of QA session?
Yes, definitely. Thank you so much, Amit sir, for the insightful session. The first question which I have is, do we need to take a third-party confirmation as per the standard from the agents, warehouses, etc.?
So, so as per the standards on auditing, the first responsibility is of the management to perform. Now, if management is performing, it is auditor's responsibility to observe the stock count. If the inventory is lying with the third-party agent, then there is a fix. Management generally will not go there. So what do you do? So the auditing procedures would actually push you to obtain this third-party confirmation. So it may not be clearly mentioned in the standards on auditing, but you will be left with no option but to obtain this third-party confirmation. Or alternatively, auditor has to go and observe the stock count.
Okay. My next question is, why do auditors look at the contract management issues?
Oh, extremely important, extremely important. So let me segregate this into two areas. One is contract management with the related parties, and then the contract management with outside the related parties. The contract management with the related parties may not be drawn at arm's length. Therefore, it is extremely important for an auditor to independently assess whether there have been any concerns in the contract management. Now, if the contract management is with the independent party, then it could be prone to fraud risk. Let's say, if someone has, if let's say, if the company has given a contract manufacturing to any non-related party, the input-output ratio is extremely important. I touched upon that. So this is so, and that is the reason there has to be a deeper focus in terms of how the contracts have to be reviewed. So there has to be some um, guidelines over and above what is there, what is mentioned in the contracts, which could act as a benchmark for the contracts.
Absolutely agree with you, sir. My next question is how to address the issue of fake goods under the brand name.
See, counterfeit goods, of course, auditors can't do much in that because auditors may not really, it's not their domain. They may not really understand what is counterfeit and all. This exercise, however, if auditors are informed of any such incidents, then it is they have to ensure that all those goods are segregated by the managements or the experts and are reviewed by some other department. So there is enough segregation of duty. And of course, one would, from an auditor's perspective, they would want to know whether the remaining space out of the entire population, whether the remaining space is clean. So let's say there are 5 warehouses and there have been counterfeit goods found in one space, one warehouse. From an auditor's perspective, they would want to get comfort on entire 5 because if there are counterfeit goods in one, there could be counterfeit goods in other 4 also. So this is where the auditors would step in, but they won't be able to do or identify on their own. They will have to have third-party evidences.
Right. My next question is how to cross-check the segments and their reporting under the standards.
So I think if I understand the question correctly, segments, someone would be talking of segmental reporting. I think
Right.
How the CODMs are looking at the segments. Initially, there was this 10% rule, but with the Indians coming in, it is all down to CODMs. How they are looking at the segments, that is the way to look. And for that, one will have to see how the MIS are presented to the Chief Decision Making Officer.
Okay. My next question is what should we consider to assess the company's adherence to social responsibility and ethical business practices, since we talked about environmental compliances as well?
Oh, very important. I think from a statutory auditor's perspective and with the limited knowledge outside those 4-5 acts, which is the GST or the income tax or the excise or customs or other companies act and all, start digging into the board resolutions. Start digging, you will get something. Start digging into the correspondence file with the regulators. It could be MCA or it could be any other team. Start have a dialogue with their compliance officers or the company secretary and ask those specific questions. And once you get to know as to how they are behaving in terms of their social and economic compliance, that is a starting point. And then from an auditor's perspective, of course, it is either NOCLAR, which means a specific reporting either to TCWG or in the auditor's report, depending on how material it is, or creating a provision. So from a statutory auditor's perspective, this is how you would want to look at this. And however, if it is an ESG audit, then of course we have a different set of standards and how do we take that forward there.
Right. Thank you so much, sir. I would now invite Tanya for some more questions.
Yeah,
Yeah,
thank you,
thank you.
Komal. Thank you so much, sir, for such an insightful session. So our next question is regarding how to identify unserviceable stock.
So as I mentioned, during my deliberation, so any stock So of course you should have visibility of the consumption pattern for let's say next 1 year or next 2 years. Next 1 year at least you should have, because any company would have done some production analysis, and if those raw materials are not going to be used in the ensuing production for next 1 year, then those goods are unserviceable, which in turn would mean that you have to ask the management as to why these goods are not provided for. That's the way to look at it.
Okay, sir. Noted. So our next question is regarding how shortage, breakages, delivery cost adjustment should be made from sale price.
So shortage, breakages, so there has to be, let's say, of course, unless and until shortages are actually there or breakages are actually there, if the breakages are already there, then you would want to net it off from the sales. So don't reduce the sale price. You will have to make an adjustment in the groupings of the sales. So two ways: either the breakages have already happened and the material have returned. So there is a case of sales return. Then of course you will have to physically pass the journal entry. You will debit sales and credit the debtor, because debtor is not going to pay up. However, if you anticipate, you are in a perishable industry and you anticipate that, let's say if I send 100, only 96 would reach, and 4, based on some trend, 4 goods will be broken or will get destroyed. So you create a provision at the time of closure of the books and then true it up basis the actual availability of information. However, if the goods are not sold, then of course they are out of the sales. Then you have to adjust in the consumption.
Yes, sir. Thank you. So our next question is regarding how far an auditor should rely on internal auditor report in FMCG.
The standards given, so standard would say that you rely on the internal auditor's report, but then integrity, objectivity, and competence of the internal auditor has to be seen. If the auditor is comfortable with the integrity, objectivity, and competence and the scope that he has taken, then no one stops him from relying. But of course, he will be answerable on the statutory auditor who signs on the financial statements is answerable on his own. He'll have to draw his own comfort. But that's possible.
Okay. Thank you, sir. So one more question. It is very difficult to physically verify the stock in FMCG sector as the company mostly have diversification in their products. So can we have any latest technological developments such as any AI tools which can make the work easier?
No, it's not really difficult. I mean, no one's asking the auditor to verify 100%. It's always a sample check. But so sample check would mean that would mean that in one location you may want to limit to maybe whatever the sample size as per your firm's policy is. But so let's say it is restricted to 90 samples, 40 flow to tag, 45 flow to tag, and 45 tag to flow. And then basis the results you can assess and you can derive your comfort whether you want to rely or no. But have a more increased reach to the locations. So each location you may want to do only 90 sample, but increase the number of locations. Because again in FHG, someone rightly said that the volume is humongous. So volume is humongous. So you visit different people, you meet different people, you understand what kind of procedures that location. So it's not only that stock count. So stock count may be restricted to 90, but please increase your coverage so that your understanding of the product increases and it gives you more comfort.
Yes, sir. Noted. So my next question is, generally FMCG had third-party contract manufacturing facility. So how should we evaluate risk behind it?
So third party, of course, the evaluation, you will have to verify what evaluation has the company done to select that vendor. Does the vendor have any prior experience in manufacturing that product? What is the how ethical are the promoters? And what are the terms of conditions with the third party vendor? And because as I mentioned, the input output, so these are risk to fraud. So input-output ratio, so let's say he may be producing out of 10 kg of RM, if 8 kg of FM was to come out, finished goods, he may be just giving a 7, and one he may be selling it on his own. So, all those factors are really, really relevant both from the company's perspective as well as from the statutory auditor's perspective. So, of course, one would need to gain comfort on the processes of what the company has done and what processes are there in the third party setup. That is also important. Only because of these 2, 3 important things I told you.
Yes, sir. Noted. So my next question is regarding the confidential data related to a product. For example, if a data are sold in the market, will it be a fraud? Does an auditor address it or ignore it as out of scope?
Confidential, so my question is actually not very clear, but I can try and frame the question. So I'm assuming that someone may have stolen the goods and then may have sold in the market. If the goods are already stolen, the company may have already kind of done an FIR or lodged an FIR or taken a hit in the provisions and all. However, so that is the end from a company's perspective, and from an auditor's perspective, one will have to see whether the reporting is appropriate or not. When I say reporting, I mean how material is this. But otherwise, if a stolen goods are sold in the market, then of course this is illegal and cannot be done. And so auditors would need to act accordingly.
Okay, sir. Thank you. Sir, just one last question is regarding the revenue recognition in case of slotting fees. For example, there is a company A who has a policy of paying slotting fees to retailers in order to have the products allocated to more advantageous space in the retailer premises for a defined period of time. So in that case, how should the revenue, at what time, how should the revenue recognize for that slotting fees?
So slotting fees is generally over a period of time. Then one may want to whatever is the cost of the slotting over a period of time, that needs to be reduced from revenue, whatever is the total revenue. So of course, all these adjustments are done as part of the grouping. But that's my view.
Thank you, sir. That's all from my side. Now, I would like to call Anil ji for formal vote of thanks. Thanks a lot.
Thank you, ma'am, for this question answer session. First of all, on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I extend my heartiest thanks towards today's star speaker of the day, C. Amit Katra ji. He has enlightened all of us regarding this various intricacies as well as the key audit matters relating to this FMCG sector. Frankly speaking, I have gained a lot through your deliberations. I hope our members also gained through your expertise as well as your advice and knowledge shared by you, sir. So you have spoken thoroughly, continuously for 2 hours, as well as very in a very efficient manner. You have covered all the question answer session also, sir. So thank you so much on behalf of AASP of ICI, sir, for sparing your valuable time as well as for this knowledgeable deliberation. I also thanks both the moderators of the day, Komal Daya madam as well as Tanya Agarwal madam, for sparing their valuable time as well as moderating this webinar in a very successful manner, as well as the question answer session in a very smooth manner. Thank you so much, Komal madam. Thank you so much, Tanya ma'am. And once again, thank you so much, Amit sir.
Thank
And
you, sir.
last but not the least, I also extend heartiest thanks towards all the participants of today's webinar. Thank you so much, sir. Thank you. Thank you.
Thank you, sir. Thank you. Bye. Thank you.
Namaste. Namaste.